Maybe they're revolutionizing the car industry, though.
That's like Michael Jordan loving going to a fifth grade basketball game and swatting balls right and left. Love it, love it, love it, love it, love it. And I hope that's the way every car company does it.
Why do they not want to be a car company? I don't get it.
Welcome to the Bash Tesla Valuation Show. I'm your host, Paul. This is Mo. We're going to talk about Tesla and how it's not justifiable in its current valuation. Spoiler alert to everybody who's coming on here to learn something. You're going to learn how to value a company and how to be reasonable about your valuation and assumptions. Now, at the end of this video, you finish it with, God, this guy doesn't understand innovation in Tesla. I want you to do me a favor. I want you to flush your money down the toilet because you are stupid. With that said, let's proceed on and talk about Tesla.
All right.
So guys, let's talk about the tech company, the software business that's known as Tesla. Hey Mo, what percentage of their revenue comes from cars?
I think it's about 90%, maybe 85%.
You're exaggerating. It's like 87 or 88%.
Oh, damn, I was off.
Don't be a douchebag, Mo.
I was off.
It's a tech company, bro.
But also, I could argue that they're a roofing company too.
I know, exactly.
So.
Well, I think just, anyways, all-time high.
Why do they not want to be a car company? I don't get it.
Because car companies have a bad valuation.
Well,
price to sales ratio on a software business is 6 to 9. On a car business is 0.5. Very big difference.
I love it.
Let's look at their gross profit margin. Okay, 23%, not bad. Bottom line, pretty solid, guys. Still not software business. Software business profit margins are 50 to 80%. Gross margin here, 23%. So this is gonna be awesome.
Maybe they're revolutionizing the car industry, though.
They are. By the way, I do believe they're revolutionizing the car industry. Yeah. I think we're going to have, Ford has already said they want to make their business model essentially what Tesla is.
Business model will move towards.
Well, that's revolutionizing the car industry. I do think that's the case.
It's not revolutionizing the entire industry, just the buying
I think that's a huge part of it, though.
I love the part of it, though. I was actually just talking with the dental hygienist this morning. We were talking about cars, and she was like, hey, what are you looking at? And I'm just like, so she went to the Porsche dealership, and she got a Porsche.
She's a dental hygienist, and she's getting a Porsche?
Yeah. Anyways, she... They were trying to charge her 9% above MSRP after the car came in. She ordered it, it came in, they were like, hey, we're going to add on 9%.
What'd she say?
She said no. They went into this big battle, and she ended up getting it at the MSRP.
What Porsche dealership?
The one that you bought your car from, actually.
That's pretty shady.
Yeah.
That's pretty shady.
Yep.
Okay, so...
Anyways.
I do think that Tesla has revolutionized the car industry.
Ford's moving in that direction. Jim Farley?
Yes, in multiple ways. They've done the electric vehicles. They've been the leader of that one. I think they've really driven the future of electric vehicles. There's no denying that. 100%. I think the whole idea of this is the price, effing pay it.
Love it.
Love it. Love it, love it, love it, love it, love it. And I hope that's the way every car company does it. I remember 25 years ago when my dad was buying a Range Rover. At that time, they said something like, yeah, we're not negotiating price. And I was like, that's so great. Mm-hmm. That's so great. Now, for those of you who get your jollies off negotiating a car dealership, I'm going to tell you right now, that probably means you're not a good business person or investor. Mm-hmm. Because that's like Michael Jordan loving going to a fifth grade basketball game and swatting balls right and left. That's what that is.
Every single thing in this room we're sitting in right here, we paid for because the company said this is what it costs and we just paid for it.
Yep.
Everything in the world should be that way, except for maybe houses. That's it.
I really wish houses were the same way.
I do too, but they can dynamically shift. But cars ain't shifting. If it costs $80,000 to build it, there's your price. Maybe a little bit more for get your margins. That's it.
All right.
I don't understand it.
Return on invested capital last year was pretty solid, 15.2%. All-time high in Tesla is $414.50.
Thanks.
In November of 2021. So let's go take a look real quick, guys. For those of you who don't believe that stocks can fall even though their numbers look better, here is the quarter ending November 2021. They did $17.7 billion. They're now doing 23. Mo, is 23 greater than 17.7?
I think it is.
How much greater is it? I don't want to burn your brain here.
Don't burn my brain.
It's roughly 30% better.
Thank you.
But why is the stock going from 414 down to 101 back up to 186 right now?
Disruption?
So what Mo is trying to say is stocks are a voting machine in the short run and a weighing machine in the long run. The question becomes, what's fundamentally behind Tesla? That's what's going to drive the long-term value. But you got to pay a reasonable price for Tesla today. If you believe that anything great should be great and you focus on the story, no numbers, what you're essentially saying is there is no price too high. And you might sit there and look at me now and say, no, that's not the case. Yes, you are. You have two options. You can go lose tons of money thinking the way you're currently thinking, or think like an investor and lose a lot less money. What are you going to say, Mo?
I'm just looking at their revenue on a year-to-year basis. It's incredible.
Incredible growth, isn't it?
Incredible growth and stock price not following suit.
So 2021, they did 53.8. Last year, 81.5. This is when they ended the year, 53.8 billion. How much more revenue is this? 28 billion on that is 55% roughly. Wow. And their stock price is down in half.
Yep.
More than half.
More than half.
More than half. So go figure that. No, that could mean.
And it went to $100, $101 at one point.
So it was down over 75% at one point. Now you could say, man, Tesla's a buy. And it could be. It very well could be. But the question is, what did it have to sell for? Let's start from the very beginning. If the average car company, Ford, Honda, all these things sell for between 0.5 and 1 times revenue, let's assume Tesla is going to have this big premium, and let's call it 1.5 times revenue. Okay? Right now, it's at 7 times revenue. So it's got to fall 80% from this level just to hit 1.5, assuming they don't grow a lot in the next few years. Now, our good friend Cathie Wood thinks Tesla's bear case is $1,400 a share. How many times more is that right now?
Wow, what's the current price? 187?
Yeah. So what is that? Like 7.5 times maybe? Let's call it 7 times.
That's by 2025.
2027.
2027?
Maybe 25.
I can't remember.
Look it up. Sure. But that's her bear case, which means her low case. So in order to get that, guys, and if Tesla at $1,400, that's 7 times more, current market cap.
27. The
current market cap is $591 billion. Call it $600 billion. Times 7 is $4.2 trillion. Okay, so for the stock price to hit $1,400 a share, you have to have a $4.2 trillion market cap. Now, based on that, and based on them getting, let's say the normal car company of 0.75 times sales, what's 4.2 divided by 0.75? That would be, divided by 3 there is 14, $5.6 trillion in sales to justify that value. That's valuing them like a normal car company. $5.6 trillion in sales. For those who don't know, GM and Amazon do $500 billion in sales. 9% of this, 1/11 of this. And she's saying that's going to happen by 2027. But of course, I'm a curmudgeon, and I'm saying that, let's say that their price to sales stays at 7. All right, so $4.2 trillion divided by 7 is $600 billion. Okay. A lot more reasonable. Mm-hmm. But they're doing $81 billion right now. And what year is going to happen? 2027?
27.
By the end of 27?
Yep.
So 24, 25, 26, 27. 4.5 years. So let me do some quick math for you. 600 divided by 81. It has to grow 7.4 times in the next 4.5 years. To the power of 1 divided by 4.5 is a growth rate of 56% per year.
Yeah,
they need to grow their growth rate by 56% a year to hit their lowest bear case, according to Cathie Wood. Go ahead, Mo.
How's a $600 billion company going to do that?
Well, let's look at analysts and see what they're saying.
Okay.
Analysts are calling for...
Analysts who are very, very, very rosy.
Look at that. The highest is 28.
Yeah.
The lowest is 17% in the next 5 years. $230 billion in revenue.
So the cheerleaders of the stock
The cheerleaders of the stocks who tend to be wrong on the bad side are not even giving Tesla that kind of growth. And Cathie Wood saying that's her base case, her lowest level. Guys, every investment's the present value of all future cash flow. We're going to go in here and we're going to do our stock analyzer tool. The stock analyzer tool is going to tell us, based on our assumptions about the future, the price range for Tesla given those assumptions. Mo, one thing I want you to do is...
Let's do 4 years.
Yeah, do 5 years.
5 years.
Give it a little bit of 5. And what we're going to do here is before the end, after we show our current numbers, stick with us because we're going to show you what would have to happen to the company, what they have to do in order to justify today's price. Forget about Cathie Wood's $1,400 bet. Today's price. So please hold on a second. Ready? Come to me. Mm-hmm. So guys, I did a 20-year analysis, 20. In our software, you can do 1 to 20 years. And by the way, if you want our software with all the tools, including the stock analyzer tool and the community, $1 per day, go to everythingmoney.com. $1 per day. it's going to be a better investment than ARK Investments and Tesla. But I have made assumptions here, and I'm going to show you these assumptions. I'm going to make the screen a little bit bigger. Revenue growth levels, 10, 15, and 20%. Just to show you how much 20% is for 20 years, 1.2 to the power of 20 times 81 billion would take them to 3.1 trillion in revenue. 3.1 trillion in revenue in the next, how many years? 20 years.
3.1 trillion?
Yeah. Okay. Possible? Is it probable? I don't know.
I don't think so.
But it's possible. Let's do it this way. If their average car 20 years from now is $120,000, because the average car right now is like 45 or 48.
I think it's 45.
They have to sell 26 million cars a year in 2020. Okay. Keep in mind, guys, in the US, there are like 50, how many cars are sold every year that's new in the US? Like 15 million?
Yeah, I think it's like 14 or 15 million.
Yeah. Call it 20. So they got to basically be bigger than the entire new car market today in the US. But that'll grow probably over time. Okay? Now, profit margin, I did 8, 14, and 20. This is a little bit lower than a software business. So I'm assuming their software is correct. They're going to start making tons of software at a really high margin. I matched the free cash flow. PE. Now you're going to argue with me on PE. Guys, if you base your PE, like that idiot Meet Kevin, based on the current PE, he said 70 was a deal. It's at 50 right now. That's when it was at 200 or something like that. He said 70 was the deal. I put 17, 20, and 23, which I still think is high. Because for the largest company in the world, which will probably be at that point to hit that, that's a really high multiple. And for my returns, I put 12, 15, and 18. Because the higher my assumptions, the bigger return I need for my margin of safety. Mo, what'd you do for your 5-year analysis?
So revenue growth, I did 15, 20, and 25.
Okay.
Profit margin, 5, 9, and 13.
Okay.
Free cash flow margin a little lower, 2, 5, actually a lot lower, 2, 5, and 8. PE, 20, 23, 26. Same numbers for price to free cash flow, and my return of 11, 13, and 15. Ready to show my numbers?
Yep.
15 to 36, 91 to 150, 45 to 82.
Well, here's how stupid you are. Mine's a low price of 56, a high price of 280, middle price of 140. So guys, what this says is if you believe my highest assumptions, you can buy the stock today at 280 and still make an 18% return. So at 187, imagine how well you're going to do. Imagine how well you're going to do. Now, for me to get green in my middle section, oh boy, Mo, what are you getting here today?
So I'm putting in revenue growth of 40% for the next 5 years on my high side, leaving everything the same. You know what? Let's drop this to 10. Let's see how good it gets.
There you go.
So there you go.
It's barely on the discounted cash flow in the positive. Barely. Guys, I know what to tell you. Yes, I'm a jerk, but go look at all our videos in the past and everybody said, I didn't get it. Now the only criticisms of me is, Paul, you're buying these stocks, they're going down. Yeah, I know. And I'm going to keep buying BABAs and all that stuff. I avoided the 90, 95, 100% collapses. I'm fine with that. And guess what? People have to pay attention to my stuff. And I'm going to be very happy as stocks fall. That's the difference between me and everybody else. I am ecstatic when stocks fall. I was trying to do options today. I'm like, how boring. Stocks are up. This sucks. Yep. Thank you very much, guys. Everythingmoney.com, $1 a day for 7 days. Try it out.